Everyone, welcome to the Stock Trading Tutor channel. If you'd like to create a free Demat account with Alice Blue, click the link in the description and fill out your details. Now, let's look at the basics of volatility. Now, what is volatility? This is a statistical measure of the dispersion of returns for a given security or market index. Volatility can either be measured by using the standard deviation or variance between returns from that same security or market index. Commonly, the higher the volatility, the riskier the security. In India, the measure of volatility is done by India BIX. So let's look at some of the basic terminology included. First is actual current volatility. This is the current volatility of a financial instrument for a specified period, which can be from 30 days or 90 days, based on historical prices over the specific period, with the last observation being the most recent price. Next, let's look at actual historical volatility, which refers to the volatility of a financial instrument over a specific period, but with the last observation on the date in the past. Next term is actual future volatility, which refers to the volatility of a financial instrument over a specified period starting at the current time and ending at a future date. Next, let's look at historical implied volatility, which refers to the implied volatility observed from historical prices of the financial instrument, which are normally options. Next is current implied volatility. This refers to the implied volatility observed from current prices of the financial instrument. Next is future implied volatility, and this refers to the implied volatility observed from future prices of the financial instrument. Let's look at some of the types of volatility. First is price volatility, and this is based on demand and supply. Next is stock volatility, which is based on risk. Then there's the historical volatility, which is based on past price movements. The implied volatility is based on future price movements. And then there's the market volatility, which is based on bullish or bearish market. Let's, let's see how to measure the volatility. The primary measure of volatility used by traders and analysts is a standard deviation. This metric reflects the average amount a stock's price has differed from the mean over a period of time. It is calculated by determining the mean price for the established period and then subtracting this figure from each price point. The differences are then squared, summed, and averaged to produce the variance. So let's look at the steps in calculating it. First, you have to calculate the average price for the number of periods or observations. Then you have to determine each period's deviation. This is the close less average price. Next, you have to square each period's deviation. Then you have to take the sum of the squared deviations. Then you have to divide the sum by the number of observation. The standard deviation is then equal to the square root of the number. So here's the formula in case it's a little confusing. So the daily percentage change is calculated by the current price minus yesterday's price divided by yesterday's price whole multiplied by 100. So first thing to understand for investors about volatility. Now, price volatility of a trading instrument can define the position sizing in a portfolio. When certain cash flows from selling a security are needed at a specific future date, higher volatility means a greater chance of a shortfall. Higher volatility of returns while saving for retirement results in a wider distribution of possible final portfolio values. Higher volatility of return when retiring gives withdrawals a larger and permanent impact on the portfolio's value. Price volatility presents opportunities to buy assets cheaply and sell when overpriced. Portfolio volatility has a negative impact on the compound annual growth rate, which is the CAGR of that portfolio. Volatility affects pricing of options, being a parameter of the Black-Scholes model. Thank you for watching this video. For more videos on stock market and trading, please subscribe to this channel. If you'd like to create a free Demat account with Alice Blue, click the link in the description and fill out your details. You'll also get intraday recommendation calls and you can learn robot trading software for free.